Okay, let's dive in. Welcome, everyone. This is now our 12th time doing What Would Peter Lynch Do?, where we try to unpack the wisdom of the legendary investor Peter Lynch. And today we're tackling something that came directly from you, our listener, a question that honestly gets right to the heart of a frustration many people feel when starting out. You've heard Peter Lynch, really emphasize investing in those good companies, solid businesses, good growth. But then you look at the market. You see Apple, Amazon, Microsoft, hundreds, maybe even thousands of dollars for just one share. And then there's Warren Buffett's Berkshire Hathaway Class A, currently over $700,000 for a single share. Just incredible. And, it's totally understandable. You see those numbers, particularly that Berkshire A price, and the thought hits you, I can't even buy a week with my income, so is stock investment impossible?
That's a very, very real feeling. Seeing those huge nominal prices, it can feel like this massive wall, can it? Especially if you're starting with, maybe a more modest amount. Makes you think the market's just for the super wealthy.
Exactly. Like you're somehow locked out from owning these great businesses Peter Lynch talked about. But that feeling, while, yeah, totally understandable, it's just not the full picture. And based on the material you send over, the answer to is it impossible is a definite no.
Oh, absolutely not. High individual share prices do not make investing impossible. Not at all. So the mission for this deep dive really is to look at these sources and show you clearly that you can invest in great companies, the kind Peter Lynch would admire, even if you don't have huge sums of money.
We're going to unpack his wisdom, look at today's market, and find some practical ways to actually use his principles without needing, $500,000 for one share. And what's really interesting, the sources suggest some of these ways are actually, well, kind of advantageous for investors starting smaller.
That's right. They sort of level the playing field in some interesting ways.
Okay, this is where it gets really interesting. But before we jump into the how-tos, maybe let's just take a quick second to understand why some stocks get so expensive like that. It's not always just, random growth.
Yeah, sure. So typically when a company's stock price gets, let's say, uncomfortably high for individual investors, they often do something called a stock split. It's basically a way to lower the price per share.
How does that work exactly? Like a 2-for-1 split?
Yeah, exactly. So in a 2-for-1 split, if you owned one share trading at $1,000, after the split, you'd suddenly own two shares, each trading at $500. The total value you hold is the same, the $1,000.
Ah, okay. So your total investment value stays put, but the price for one share is cut in half. Makes sense.
Precisely. And the idea is it makes the stock feel more accessible, easier for individuals to buy, and it can also increase liquidity, meaning it's easier to buy and sell in general. Lots of big companies have done this many times.
But then you've got Berkshire Hathaway Class A, the big exception, famously not split. That's $700,000 plus price tag. That's not an accident, is it? It's tied to a specific philosophy.
Exactly right. If you look into it, Warren Buffett deliberately kept the Class A price high because he wanted to attract a certain kind of investor. He wanted long-term owners, people focused on the business itself, not, short-term traders trying to make a quick buck.
So keeping the price sky high was a way to discourage speculation.
Pretty much, yeah.
Yeah.
It acted as a filter.
Yeah.
That deliberate choice, combined with obviously Berkshire's amazing performance over decades, is why you see that eye-popping number. It's a feature for his goal, not really a bug.
Okay, so high share prices exist, sometimes by design, sometimes just because of growth. But the fundamental question for our listener remains. How can someone with a more, let's say, average budget invest in those quality businesses Peter Lynch liked when one share costs so much?
And that's exactly the puzzle the source material helps us figure out. The great news is, Peter Lynch's core idea was always about the business, its value, its potential, its fundamentals. It wasn't just about the dollar price of one share on one particular day. You're buying ownership. And there are several really practical ways to get that ownership, even with a smaller budget.
All right, let's break these down then, based on the sources, maybe starting with some of the newer tools. The first one seems to directly tackle this high price issue, fractional shares investing.
Yes, this is a relatively modern thing offered by a lot of brokers now, and it really is a game changer for this exact problem. It lets you buy portions, fractions of a single share.
So wait, instead of needing the full, say, $1,000 for that expensive stock, I could put in just $100.
Exactly like that. With fractional shares, you invest your $100 and you'd own 0.1 shares of that $1,000 stock. And your investment then grows or shrinks by the same percentage as the full share price.
Wow, okay, so that directly lets someone, even with limited funds, buy into those really expensive good companies Peter Lynch talked about. You could put in $50, $100, whatever fits, right? Even if one share costs thousands.
Precisely. The advantages are obvious.
Yeah.
It makes these stocks affordable, accessible, and it also makes it much easier to diversify. You can spread smaller amounts across several expensive stocks instead of having to save up for ages just to buy one single share of one company.
That sounds great. Are there any catches, any downsides to fractional shares?
The source does mention a couple of things to be aware of. First, not every single broker offers it, although many do now.
Hmm.
And sometimes it might be limited to certain stocks, usually the big well-known ones. Also, maybe less of an issue now, but there can sometimes be slight differences in things like shareholder voting rights depending on how the broker sets it up. But just for getting the economic exposure, it works really well.
Got it. Okay, so that's one powerful tool. Let's move to method 2 from the sources, which is, well, incredibly popular, especially for diversification. Exchange-traded funds, or ETFs.
Right. And we've touched on ETFs before. Basically, an ETF is an investment fund that holds a whole collection of assets, usually stocks. But the fund itself trades on an exchange, just like a single stock would.
So how does buying an ETF relate to Peter Lynch saying invest in good companies? It sounds like you're buying a whole mix.
Well, think of a broad market ETF, especially one like an S&P 500 tracker, as investing in a curated basket of good companies. The S&P 500 index, for example, holds the 500 largest, most established public companies in the U.S. So when you buy one share of that S&P 500 ETF,
You're instantly getting exposure to all 500 of them.
exactly, you get a piece of the collective growth and performance of all those major businesses all bundled together.
So it's a way to own a slice of hundreds of these good companies at once, and the ETF share price itself is usually much more manageable than buying even one share of, say, Amazon or Microsoft individually.
That's the key advantage, yeah. Massive diversification with just one purchase, often at a pretty low price point per ETF share. It dramatically reduces the risk you'd have if you just owned one or two stocks. Plus, ETFs generally have very low operating costs. That's the expense ratio. And they're super easy to buy and sell during the day.
Okay, but if an ETF just tracks the market average, does that mean you miss out on the chance for those huge, 10-bagger type gains Peter Lynch sometimes found with individual stocks?
The source notes that yes, that's generally the trade-off. Because you're getting the average performance of many stocks, you're less likely to get those absolutely massive returns from one single company shooting the lights out, compared to if you'd put all your money just in that one winner. But for a lot of investors, especially if you're just starting or don't have tons of time for deep research, it's a worthwhile trade-off. You're essentially accepting market-like returns in exchange for that instant diversification and lower volatility compared to picking stocks yourself. It guides a really consistent way to benefit from the market's overall long-term upward trend.
And the source specifically highlights the S&P 500 ETF as a great way to access those good companies.
It does. Because when you buy an S&P 500 ETF, you're getting that slice of the 500 biggest U.S. players, the Apples, the Microsofts, the Amazons, NVIDIAs, all those names you might have felt were out of reach individually. One ETF share, often pretty affordable, gives you a piece of all of them.
All right, so fractional shares for pieces of expensive stocks, ETFs for baskets, including them. What's a third method the sources talk about?
Method 3 is, well, it's more like classic Peter Lynch. Requires more legwork, but offers potentially higher rewards, actually finding undervalued or cheaper good companies. Not every great business out there is already a giant with a huge share price.
Ah, like trying to find the next big thing before everyone else does and the price shoots up.
Precisely that. Peter Lynch was brilliant at finding companies that were maybe not well known yet, or perhaps they were temporarily out of favor with the market for some reason that didn't really affect their long-term strength.
And the upside there is potentially huge returns if you get it right while the stock is still cheap, like $20 or $30 a share.
Exactly. If you can identify a really successful, growing business, while its stock is still relatively inexpensive, say $20, $30 a share, before it becomes a $500 giant, the returns can be substantial.
But that sounds like it takes a lot more effort, right? You have to do your homework.
Oh, absolutely. That's the key requirement, and also the risk. It demands serious personal research. You really need to dig into the business model, the financials, the competition, management, future prospects, all of it. And there's always the chance that a stock looks cheap because, well, it is cheap for a bad reason. Maybe the company's struggling, has too much debt, or the industry is declining. So yeah, it's definitely a path for those willing and able to put in that significant research time.
Okay, so that's the high effort, high potential reward path with more individual risk. What was the last practical method mentioned?
The fourth one is much simpler. really just relies on how markets sometimes work. If there's a specific expensive company you really like and they haven't done a stock split in a while, you could just wait and see if they announce one.
Huh. Just play the waiting game and hope they make it cheaper.
Essentially, yeah. Like we discussed, companies often do split their stock when the price gets very high, partly to make it more accessible. If a company you're watching announces a split, the price per share will drop, maybe bringing it down into a range where you feel comfortable buying whole shares. It takes patience, obviously, and there's no guarantee it'll happen, but it's a simple strategy to keep in the back of your mind.
These are all really practical ways around that high price hurdle. But I think the most crucial point, something Peter Lynch himself emphasized, really helps frame this whole price issue correctly.
Yeah, it really gets to the fundamental nature of what stock ownership is. Peter Lynch had that powerful quote,
Stock is not a lottery ticket, but ownership in a company.
"It's such a simple fundamental idea, isn't it? But so easy to forget when you see a $700,000 price on one share." His quote just cuts through that focus on the absolute dollar number of one piece of paper or one line on a screen. What really matters, what you own, isn't the share price itself, but the stake it represents, a piece of the actual underlying business. Its assets, its earnings, its potential to grow and make more profit in the future. That's what you're investing in.
So it doesn't really matter if you own, say, a tiny fraction of that $700,000 Berkshire share via fractional investing, or you own a whole share of a $100 growth stock you researched, or you own a share of a $50 S&P 500 ETF. In every case, you're just owning a piece, big or small, of a good company or a collection of them.
Exactly right. The high price of one share of one specific famous company doesn't block you from investing. It just means you need to figure out how to access ownership in good businesses using the capital you actually have.
And it seems like, based on the sources, a really strong recommendation comes through for using those low-cost ETFs as a primary way to do this, especially for getting access to those broad collections of good companies, like the major market indexes.
It really does. The message is clear. You can absolutely get involved in the market's growth. You can invest in good companies even with a small starting amount. And ETFs are just a remarkably efficient way to do it,
Yeah.
especially the broad market ones.
The source even gives specific examples of ETFs that trade at really accessible prices, often, well under $30 a share. Of course, prices change daily, but these examples show it's definitely possible.
Yes, they offer a very clear path. For example, they mention the SPDR portfolio, S&P 500 ETF, the ticker is SPLG.
Now, hold on. A lot of people know SPY, the big S&P 500 ETF, but that often trades for hundreds of dollars, right?
Yeah.
$400, $500 sometimes. Is SPLG different?
Functionally, no, not in what it holds. SPLG tracks the exact same S&P 500 index as STY or VOO or IVV, those other big ones. The key difference is structural. SPLG is deliberately designed to have a much lower price per share. The source examples put it in that like $25 to $30 range. It's specifically aimed at being more accessible.
So you get the same exposure to those top 500 U.S. companies,
Yes.
the Apples, Microsofts, Amazons, but at a price point that's way easier to handle for smaller investments.
Exactly. Same underlying investment exposure, much lower entry price per share. And crucially, the expense ratio mentioned in the source is incredibly low, right?
Wow.
0.02%.
Yeah, 0.02%. That seems tiny.
It is tiny, percentage-wise. But it's so important because that fee gets taken out of your returns every single year, year after year, no matter what the market does. Over decades, the power of compounding means even a minuscule difference in that expense ratio can add up to a lot of money left in your pocket versus paid out in fees. It really raises that crucial question about optimizing your long-term net returns.
Wow, okay. That small percentage really compounds negatively over time if it's too high. What other low-cost examples were mentioned?
Another one was the Schwab U.S. Broad Market ETF, ticker SCHB. This one's even broader. It tracks the entire U.S. stock market, large, mid, small companies, thousands of them. Also has a very low expense ratio, and the source examples had it trading around like $20 to $25.
So SPLG is the top 500, SCHB is like everything in the U.S. market.
Pretty much, yeah. It gives super broad diversification. And then there's another similar one focusing just on the large U.S. companies again, the Schwab U.S. Large Cap ETF, SCHX, also around $20, low fee. The sources mentioned a few others too, like SFY, maybe around $15, DIV under $20, which is dividend-focused, and even one called BKLC that tracks large caps and remarkably had a 0.0% expense ratio listed in one quote, though zero is exceptionally rare and always worth double-checking. But the main point is clear. These low-cost, diversified options are readily available at accessible prices.
So how do these low-cost broad ETFs really tie back to Peter Lynch's core ideas?
Well, if you think about Peter Lynch's emphasis on uh, Yenodor, that idea of compounding, where profit generates more profit, these broad market ETFs like SPLG or SEHB are fantastic tools. They let you directly participate in the long-term compounding growth of the whole economy, the collective success of all its leading businesses.
So if you don't have time for deep stock picking.
Exactly. If you don't have the time or maybe the expertise for that deep individual company analysis, investing regularly in a low-cost, broad ETF is a highly effective way to apply his principle. You're essentially owning a piece of many profitable businesses, betting on the overall engine of economic growth. And you can do it even starting small.
What about his other famous advice? Jag kan you invest in what you know. Can ETFs fit there?
Potentially, yes. You could use specific sector or thematic ETFs. Maybe you really understand, say, renewable energy or cybersecurity or healthcare tech. You might find an ETF focused just on that area. However, the source does caution that these often come with higher risks, more volatility, and sometimes higher fees. You really need to understand that specific sector deeply, its risks and potential, not just buy the theme blindly. It's a more concentrated bet than a broad market fund.
Okay, so beyond just finding an ETF with a low share price, the source stressed looking at other things before you invest, right?
Absolutely critical, yes. First, always check the current price, obviously, since they change constantly. But maybe even more important is to look very closely at the expense ratio. We talked about it, but it's worth repeating. That annual fee matters hugely. Lower is always better. The source really hammers this home, pointing to examples like 0.02% or maybe 0.03% to 0.1% as being really excellent targets.
Why should someone sweat such a tiny difference like 0.05% versus 0.15%? It seems negligible.
Because it's not negligible over time. That difference, however small it looks, comes out of your investment every single year, compounding against you. Over 10, 20, 30 years, that tiny difference can literally mean thousands, or even tens of thousands, less money in your pocket. Think of it like a small leak in a big tank. Over time, a lot drains away. You want the smallest leak possible.
That's a really powerful way to put it. Okay, what else besides the expense ratio?
The source also mentioned checking the tracking error. Basically, how well does the ETF actually follow the index it's supposed to mimic? Lower tracking error is better. It means the fund is doing its job accurately. And finally, just briefly, considering volume or liquidity. Is the ETF traded enough each day so you can easily buy or sell shares at a fair price when you want to? Usually less of an issue for major index ETFs, but good to be aware of.
Right. So it's not just about finding the absolute cheapest share price for an ETF, but finding a good quality, efficient ETF with low fees that does what it says it does.
Precisely. Quality and cost efficiency are key, not just that initial price tag. And throughout all of this, just remember Peter Lynch's core message. Think long term. Understand what you own, even if it's a basket like an ETF. Patience and, continuing to learn about the market or the companies you're invested in, that's really crucial.
So let's bring it all back home for our listener who asked that initial question, is investing impossible with high stock prices? The big takeaway seems clear. Absolutely not. Don't let those huge numbers on famous individual stocks scare you off. Stock investment is definitely possible, even if you're starting with limited funds.
Definitely. The sources lay out clear paths. Fractional shares let you buy slices of the big names. You can hunt for those undervalued gems if you're up to the research. You can even, wait for a potential stock split.
And maybe the most powerful, most accessible tool, especially for aligning with Peter Lynch's idea of owning good businesses long-term, seems to be the low-cost ETF.
Yes, I think that's fair to say. ETFs, particularly those broad market ones, tracking the S&P 500 or the total market again, thinking of examples like SPLG, SEHB, SEHX, with those lower price points, they are really powerful. They let you invest in hundreds, even thousands of good companies all at once. You get to participate in market growth, benefit from compounding, all perfectly in line with Peter Lynch's philosophy, even starting with just a modest amount.
So we really encourage you, our listener, to explore these options. Check the current prices, definitely scrutinize those expense ratios and tracking errors, and figure out which approach, or maybe combination of approaches, makes the most sense for your own situation and your long-term goals. Don't be intimidated by a high price tag on a single stock. The doors to owning great businesses are much wider open than you might think.
And, finally, as Peter Lynch himself suggested in the source material, there's a principle here that kind of goes beyond just stocks and bonds. It touches on Now, maybe a broader life wisdom. I will say a word from Lynch today, and I will say that this principle is connected not only to investment decisions, but also to life wisdom. And I will conclude by saying, see you next time. This was What Would Peter Lynch Do? Thank you for joining us today. Have a nice day.